venture investor who's looking to invest in companies that can grow really big. You know, the first is really economies of scale. So as you get bigger, your costs go lower and lower significantly, and so you'll have a price advantage. And usually economies of scale businesses also means that the basis of competition is price-based. And so you want to, you know, again, this is where consistency comes into play. If you say I have economies of scale, but people are not competing on price, then it's not consistent. And so you want to look for that. Network effects, for those of you who haven't studied that yet, that means that the more people using your product, the more valuable it is to them. So Facebook's a great example. The more people on Facebook, the more valuable it is to you, the more of your friends are on there, and the more sharing you can do. Telephones, faxes, all of these things have network effects. The more people using it, the more valuable it becomes. Or there's other kinds of network effects where there's two-sided, like markets. So eBay, buyers and sellers. The more buyers there are, the more valuable it is to sellers, and vice versa. So if you have this, you build a sustainable advantage when you do that. Because the bigger you are, it's harder for a new guy to come in and compete because they don't have all the same stuff you have in terms of the number of people using the product. Data scale, Yelp, you guys use Yelp, has all the reviews. It's really hard for a new guy to compete with Yelp because he doesn't have millions of reviews already on there. So they have, as you collect more data and you get bigger, you have an advantage. Brand is an obvious one too, but that's, you know, you can't start with brand. Brand is something that you get built, and so it's kind of more of a side effect. If you're going to say that I'm going to build a big brand by spending a bunch of money on marketing, that's probably not going to be a convincing business plan. Distribution advantage. If you have a certain kind of partnership with someone, exclusive partnership, or other way to get to a customer in a way, or you have real estate is another way of thinking about this. So you have a real estate advantage, it's a green field, and you're going to gobble up these spots, and then no one else is going to be able to take that position, have that real estate, and then you're going to have an advantage over time because you're going to be able to serve people in those geographies or in that niche in a way that other people couldn't. So look for these, call them out specifically, and explain how there's a virtuous cycle there and that makes you stronger over time. Now people love to say patents, IP. I think that's important in some kinds of businesses. There are definitely certain businesses like biotech, some sorts of clean tech, manufacturing, where there's a patented, very proprietary process that's really hard to replicate. It gives you a really big advantage. A lot of those come out of universities, so I'm sure some of you might have that. That's great. Patents are really important, and that can be your competitive differentiation, and as long as that's also part of the basis of competition in the market. But if you're just going to patent a bunch of stuff, and other people have patents too, and you're a small company, you're not going to be able to defend that. You don't have the money to defend that, and people can engineer around it. Don't tell me software patents. That's the worst, right? I mean, that's going to be a dime a dozen, unless you have some really hardcore algorithm. That's really interesting. Patents really are good, but that's not really going to do it. Management. Now, this is hard because I know when I was in business school, I participated in a business plan competition, and while you may have some credentials that apply to the domain, you're probably not going to be the best team out there in the world to attack that problem. Right? You might have a technical person that is maybe the best scientist or engineer to solve that, but at the end of the day, the team as a whole is probably not the best. So, which is fine, but it's still important to be able to articulate why you're a good team for at least starting the business off. And so you're not going to be able to maybe address this problem head on, but you can be cognizant of the fact that you may have gaps, that you have maybe weaknesses, and how you have plans to address them. It shows a lot of maturity to be able to say, we really don't know how to sell to this target customer. No one on our team has ever done it, but that is like #1 on our list in terms of recruiting. We're going to find someone. Or we've already found someone that's willing to come on board once we have funding or something like that, in terms of advice. Or you fill them up with, use advisors and other things like that to help address gaps. But being very cognizant and honest about that really builds credibility. The other one is title inflation. You don't need CEO, CMO, COO, all of this, right? You need a CEO, no co-CEOs. That's also a red flag for investors. one leader, the person that's most dedicated, has the vision, figure it out, and commit to that. And then, or you can say, hey, you know what, I'm an interim CEO. I believe I can be the CEO for the first year, but I really think that at the end of the day, I want to recruit someone that's more senior to me to help run this. And that's fine. And I think that shows a lot of integrity, but you have to mean it and believe it if you're really doing it. And then for the other folks on the team, director level is good. You don't have to be VPs of everything either. Again, I just think when I'm dealing with younger teams, I think that shows a sense of maturity as opposed to thinking that you're going to run the whole thing. Yep.
How valuable is the talent management's insider expertise or specific industry expertise? Yeah,
like I said, that's absolutely the best, and you want to highlight that, but you don't want to overdo it. So, if you're trying to make a weak connection, it's better to just avoid that completely. But if you have a strong expertise, absolutely, and I know a lot of folks, come from different industries, coming to business school, and maybe going back into that industry, and that's great, and you want to highlight that as much as you can. And if they have certain experiences functionally, like they've actually sold to this group, or they've marketed to this group, or they've actually engineered a product that scales to that level, then you absolutely want to highlight all of that. And be very specific about how you think their past experience maps to your needs in that first year, when it's going to just be you guys and probably not be able to recruit folks initially. Financials. This one is one where I've seen people either two ends of the spectrum, really too light on the financials, or too heavy. And so there's a way in between. So I want to say numbers are less important than the model. Doesn't mean numbers don't matter, but at the end of the day, in early stage companies, the numbers are bullshit, right? I mean, everyone is making a lot of assumptions. You're guessing a lot of times. You're hoping, and everyone knows that, and that's fine. The clear thing is to be very cognizant of what those assumptions are. Try to defend them as much as you can, in terms of, like, we think this is going to be the number of customers that we can touch from a marketing standpoint, or convert, for instance, in terms of percentage in the first year. Well, why? Did you run a beta test and you got a sense of that? Did you talk to people, or are you looking at what other companies were able to do in their first years? If you have any kind of evidence that supports your assumptions, that makes it a lot more credible. And then, it's about the model itself in terms of, do you really understand what the drivers of the revenue are? Do you understand, your pricing is another big kind of variable or assumption that you make. Why do you have confidence in this pricing? If you can do sensitivity tables saying, hey, we understand that, these are the 3 or 4 drivers of the model, and these are the assumptions that we're making, and this is how sensitive our model is to that, that's even better. And you can show that, where the kind of the range of low and high scenarios are for where you may come out. That's always great. All right, this is another one. Consistent. You have to be consistent, again, like I said, with what you said earlier about this market sizing and the go-to-market plan. If you say you're going to sell X number of, or you're going to reach a certain number of revenues in the first year, well, that implies a certain price, which you're going to defend in terms of why you think you can achieve that price. And it assumes a certain number of people that you're going to sell. Well, that then means that you're going to convert people at a certain percentage. So that means you're going to touch even a bigger group. Well, how big is the market? Is the market even as big as you're saying it? Are you going to touch 50% of the market in the first year? If you're claiming that doesn't sound very consistent. Are you going to win 25% of the market in the first year? Probably not. But if those numbers don't match up, and suddenly you're saying that you're capturing the entire market, or 110% of the market, which I've seen also, then you know that there's something inconsistent. So double check and make sure that, just because I know people have a tendency to split up the work, right? Oh, the finance guy's going to do the spreadsheets, and then I'm going to do the marketing stuff. And if you don't really check your numbers and make sure that you guys are saying the same thing, it hurts credibility. Again, here again, what are your biggest assumptions? Being able to tell that and be upfront with an investor on that is key, because that's what they're looking for. I'm always looking for what assumptions has this person made, and how confident can I be in that? And as much evidence as you give to make me more confident, the better. And what are the big drivers, not just of revenues, but of your expenses? How do your expenses scale as you get bigger? being realistic about that. A lot of folks, say, oh, we're going to get to this many customers and revenues, but they haven't really added overhead in terms of thinking, oh, but I'm also going to eventually need maybe an HR person, or I'm going to need a lawyer because I'm going to do so many deals, or I'm going to need, there are all these other expenses and overhead expenses that people don't build into it. And they think that they're just going to be, them and their buddy and a salesperson, and that's it. That's not the case as you get bigger. And that's the same true with web companies where maybe you don't have a sales force, but you need to start spending more money on support and other things like that you might not have thought about. And the most important thing when you're kind of showing that one, and in the executive summary, right, at the end of the day, you're probably only going to show one table of stuff. And it could be a graph. But it's even better if while you're showing those numbers and you're showing those assumptions, that you somehow overlay, key stages of your company, key milestones you're going to achieve, so you can understand why certain inflection points might be happening. Why are you suddenly being able to grow really fast this year versus the year before? What did you do, or what did you achieve that allows for that growth? What kind of underlying metrics in terms of traffic to your site or something like that are tied back to that revenue number? So if you can show that's important, because we're always looking for what the drivers are. This is all about status and offering of the company. This is where are you today, and how much money are you trying to raise, and what are you going to do with that money? And so what have you accomplished to date is important. Showing that you have momentum, that you've invested some time and effort, that you've achieved something. The more you have of that, the better. How are you going to use the money? Really realistically, you're trying to raise, you're going to raise $500,000 for the first year to test out X. Okay, well then what money do you have to spend to be able to run that test? On who, on what? And thinking about it in stages is really important. That's how early stage investors think about it. They invest a little bit, run a few experiments, learn some information, feel more confident about the assumptions, and then put more money in. And so your milestones are really about proving out the assumptions that you're making, or giving more confidence behind those. And that reduces risk, creates value in the company.